the number one thing there is jobs, because people have to live somewhere. If there's no jobs, they're not going to have a growing population. So you got to look at some of those things. You got to look at absorption, construction, things like that. The next step is, identifying the asset.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Dr. Buck Joffrey. He's a surgeon turned entrepreneur. He's host of the Wealth Formula podcast, and he's the best-selling author of The 7 Secrets of Eternal Wealth. So Buck has helped high-income professionals move beyond the golden handcuffs that you often hear me talk about and into cash-flowing alternatives using business rigor and tax-efficient strategies to build durable wealth. I'm very excited to dig into his playbook for passive income that actually buys back your time. So, Dr. Buck Joffrey, really appreciate you being here today, sir. How are you?
I'm good. Thanks for having me.
Excellent. Yeah, thanks for being here. A lot to unpack here. You've got a whole lot going on here, and I love these types of conversations. It's not every day that we get a white coat professional physician, specifically surgeon, that has the skill set to kind of jump into the real estate world as well. I usually am in the opposite scenario. That's the world that I come from. And so most of what I focus on is educating people in that world that are just stepping in over here. And this is completely the opposite. I have a lot to learn from you today, and I'm excited about it. So tell us a little bit about your background, obviously from the medicine side of things, and then the entrepreneurial brain that you must have that pulled you in the direction of doing something bigger than that.
Yeah. Sort of classic, good student from the standpoint of the medicine stuff, ended up going to med school because I didn't know what to do with a biology degree other than go to med school or get a PhD. So I went to med school and pretty quickly decided I ended up starting out neurosurgery after med school at Michigan and ended up at head and neck surgery at UC San Francisco. Again, very academic institution, so you get a sense for doctors out there. I was doing, the whole the whole thing. I was going deep in very, very competitive specialties and some of the best institutions in the world. I kind of got burned out on academics, even though I was good at it. I think I thought I was going to end up being a chairman somewhere, and from head and neck ended up getting some additional training in plastics and ended up doing a private practice, actually. So I went from brain surgery to ultimately doing liposuction and facelifts and things like that. But the full range. But I think that transition for me in part was, I think, my own sort of falling out with academia, and then when I decided to go in that other direction of trying to being, I guess, a little bit more lifestyle oriented and that kind of thing. I also discovered almost immediately after residency training. I accidentally read one of Robert Kiyosaki's books called The Cash Flow Quadrant. And that book, which remarkably I picked up at a Mexican airport on the way back from my honeymoon, because there was no other books there, just but harlequin romance novels and that. And I didn't know who Robert was. Since then I've gotten to know him and had him on my show a bunch of times. But he that book, for whatever reason, Robert's books are funny because they're very simplistic in a way. Like you read them and you're like, that's written like for somebody who's like in 5th grade. But for those of us who never even thought about entrepreneurship because we're so busy with our head and books and thinking about jobs, for me it was like a lightning bolt. And the next thing you know, I was just a changed person, on a flight, and sort of in a very, very crazed way. And now you have to understand, like we did surgical training. So now I just finished, and I'm already like 32, 33 years old and like debt, and I just got married and, that kind of thing. But the good thing about that was that I had the whole world in front of me. I didn't really have, I think maybe my now ex-wife was pregnant with her first one, right? And so I was like, I got about 18 years to screw this up and fix it. And so I can do whatever right now. So it was like the best thing in the world. So I went all in initially entrepreneurial on the medical side. I told you I was doing cosmetics, and I ran it like a business. I didn't run it like a, I was on Dr. Joffrey on, 90210 or, that kind of show. I want to have a brand, and I went big. I borrowed a bunch of money, did a ton of advertising, $1 million a year budget. So built like this business and did that again in another area in medicine. But the net result of that is I ended up making some money. Okay. Now, my family, I come from an immigrant family. My dad is an engineer, and ultimately he was kind of the same entrepreneurial wired guy. He ended up going into real estate, and for the most part, for the last, at this point, all of my life, he was a real estate guy. I didn't really care what he did. I didn't sound fun at all because he did it the way you think about real estate, right? He was a landlord, and we get calls all day long. And he was into low income housing. Hey, it worked for him, right? He grew up poor and became a millionaire in the US in the 80s. That's a big deal, going from like not having anything to eat, do that. But I was spoiled, right? Growing up sort of upper middle class, whatever, or, upper middle class, upper class in the Midwest, and having every opportunity in the world, prep schools and all that stuff. So I was focused on what I thought was the societal, thing to do, the thing to be on the top of the hierarchy. So, of course, neurosurgery and all that stuff, right? Anyway, when I had the money, the first thing I was, what do I do with it? Well, I wasn't wired to put it in the stock market. My dad was terrible in the stock market. The .com bubble, he's like the worst investor on earth and lost millions of dollars. And so ironically, my upbringing was a very different perspective, where that put your money in the stock market, let grow that stuff, was a risky proposition. That wasn't the safe proposition. The safe proposition was to put it in real estate, like he'd been doing now for, I don't know how many years at that point, 30 years. So that's what I started doing. I started buying apartment buildings in Chicago, where I was living at that point, small ones, and I tried to buy like one or two a year, and that was kind of my goal. And then next thing you know, I was, listen, a lot of this is timing too, right? So, I bought a few buildings, and a few years later sold them for like 500% of what of my invested capital. And so I was like, whoa, what is going on here? This is something different. And in the meantime, my medical side, I can kind of get burned out on it. So I kind of made it independent, got other guys to do it. And I wanted to learn more about this space. And now understand, this is 2014, 2013. There's not a lot of podcasts out there, but I started listening to podcasts because I was trying to learn. Problem was, no one spoke to me, right? I wasn't trying to get out of a cubicle. I wasn't trying to, make a fast buck. I was trying to figure out how to put real money to work. And so I'd find a little bit of this on this show, a little bit of that in that show. I'm like, I just got to start a podcast. And the reason was that this way I could learn from people I interviewed, kind of like what you guys are doing.
Why do you think you're on this show right now?
Yeah. I mean, there's no sense in talking to people more than, that's why when you come to my show, I'm talking to economists and all that, because I'm trying to learn, learn from people that don't know more than me, that do know more than me, and so that's what I did, and I've been doing that for a decade. And somewhere along the line, with some of the successes, I had people say, "Yeah, next time you do a deal, you let me know, and maybe I can come in for a little bit of money." And then it all kind of came together. I started hearing about real estate syndication. I'm like, if I'm doing this and I'm doing it successfully, maybe people want to join me. And so I put literally on my website, on a whim, I started what I called Investor Club, Accredited Investor Club. If you're an accredited investor, come get onboarded, talk to you. And if there's a deal, we'll let you know. Started out doing that probably in 2016, and, billion of capital raised since then, multi-billion dollar real estate portfolio. That's kind of where we're at now. So that being said, I'm not just a real estate guy either. I should point out, I also don't want to just say everybody needs to be only real estate. That's not where I'm at. That's just kind of where I ended up. So
I love that, man. There's so much to unpack here. First of all, you're a great storyteller and communicator. So I really want to dig in on a lot of this, but I also want to keep it high level and move fairly quickly. You don't just go. Like, it's not normal. Some of the stuff you were doing it before it was cool, right? The podcasting, you're kind of doing it before it was cool. I think you make a really important point that I brought up we're 145 episodes in on this one. I brought this up at least a dozen times. I used to think the value was, I was a big proponent of the law of 100 hours. If you want to learn about something, spend 100 hours learning on any subject, you're going to know more than 95% of the population of the planet on that individual subject. Well, within a year, that's only 18 minutes a day. So I'm big on that. Well, that's the average commute, or less than the average commute the average person has to work. So just take that windshield time and turn that into podcast time and focus on a specific subject. That law of 100 hours is going to compound for you, especially if you start stacking the years of doing that. That used to be my mentality and still is. I still do that. I listen to a lot of audiobooks and podcasts. But listen, man, if you really want to learn about something, don't listen to podcasts. Start a podcast. If you find the smartest, if you and I don't have a relationship and I reach out to you and I'm trying to get lunch with you, there's a good chance that's probably going to cost me 10 grand, or you're going to say no, or it's going to involve really challenging lining up of schedules and flying across the country. Versus if we create some kind of platform that's going to help you build your footprint, you're generous enough to come on and give us an hour of your time. And I'm lucky enough to not only be able to ask you the questions, but to be able to record it. And just like you mentioned Robert Kiyosaki's books being a simple read, but with profound concepts in there. Usually you say Robert Kiyosaki, it's the purple Bible, right? It's the rich dad, poor dad.
The purple pill.
Right, exactly. But I'm actually one of the few that agree with you. I got more out of Cash Flow Quadrant than I did out of Rich Dad, Poor Dad. But there's a parallel here with what you're saying about podcasts. I have found that with his style of writing, even though it's super simplistic, there's some really important lessons there. And if you reread that same book several times over a couple years, there's a really good chance you're going to get different lessons out of it every time that you do. And that's one of about a dozen books that in my mind is worth rereading every other year. At least a few times, because you're going to pick up something that maybe is more applicable in your life right now than it was a year ago. Maybe a year ago, you didn't even realize that you heard it. You just glossed right over it. So I love that. You're the first person to come on here and be like, well, I had a website, I started an investor club, and ipso facto, $1 billion. We glossed over that, right? We have a lot of people that have raised a few million here, 10 million there. We got a couple people raising 100 million there, here or there. What do you attribute that level of, obviously you attribute that level of success, you do not get there without being a great operator and also a great communicator and a great educator. Outside of that, why do you think you've been able to raise $1 billion? Is it because of you have the accolades, right? The accolades of, I'm a neurosurgeon, I've got this background. You're a healer. Like, people are entrusting you to be a healer and make people's lives better. And so there's an inherent level of trust that comes with that. Also, I've got college buddies. You've got med school buddies and fellowship buddies and residency buddies and surgeon buddies and neurosurgeon buddies. So you have a broader footprint as well in terms of where capital is. Is it a combination of those things, or what would you say has made you so successful?
I think, I just, I have an avatar, right? I started out with an avatar, and the avatar is essentially who I was when I was, now I'm 52, maybe when I was 35, 40 years old, that was my avatar. And I always spoke to that same person. Now, interestingly, even though I'm a physician, I have never tried to target physicians. I've not tried to really target anybody other than that guy who is me. And the reason I say that is because, I think it's a mistake. There's most physicians don't think like me. and they don't want to think like me. And I'm not out here to try to get anybody to do that. I just speak what I think is true, what I believe in, and my view of the world resonates with a certain group of people. And I've been around long enough that a lot of people found me. I think it's some of it is luck, frankly. I mean, listen, I was podcasting well before, most podcasts are out there now. It's a very, very busy place to get any attention, right? And so, if you go back and I'm out there 10 years ago, it certainly helps. But I think at the end of the day, like, my focus has always been education. And even in raising capital, I think, like, when we'll have a webinar or something like that, what I'd like to do is I'm not selling this to you so much. What I'm trying to do is teach you about it. Okay. I'm going to teach you about it. I'm going to tell you why I think it's a good deal, or if somebody's presenting it, why, I'll point out the things that I think are really interesting about this. And anytime we have any kind of offering, it's a teaching moment. Now, I don't care if you invest or not, I mean, of course, as a syndicator, it's nice when people do, right? But the goal is always education. And I think if you have a single message, a single voice, and authenticity, I think people recognize that. So
I love that. That's the right approach, because even if something looks like a great deal, the reality is we don't know if it's a great deal for that person that's looking at it.
Yeah, and we could be wrong. I mean, we've not always, we've done, we've gotten right more often than not, but sometimes you can't predict certain things. Like, the economy's a tricky thing, and we came off. I was lucky in that I started at the beginning of the last boom, almost, right? We're talking about
post 2008 crash, 2013, 14, 15. Yeah. We were kind of on the way up.
A decade or more of a bull market in real estate. And, I think that certainly helps as well. Right. I mean, like anything else, it's like, you do the best you can. Sometimes you also get a little lucky too. So,
yeah, totally. Well, one of the things you said early, it kind of resonated with me, is that you said that you operated your private practice like a business, and that you were very intentional with that. Because I know that you treat multifamily as a business as well. And I've heard you use the terminology, instead of buy and hold assets, some people are investing with buy and hope assets, is that they're just kind of buying. And real estate is a very forgiving asset class. You can buy a deal that's a bad deal, and if you wait long enough, a lot of times it turns into a good deal, and you maybe look like a genius that you really aren't. But walk me through the first 100 days when you were looking at a value add multifamily deal. For you, where do you find the fastest and most defensible net operating income gains?
Well, I mean, I think I should point out at this point, like, I have operations teams that do all of that. And I think, but there's patterns that we look for, right? I mean, we look for, first, it starts with the market. You got to start with a market. And the number one thing there is jobs, because people have to live somewhere. If there's no jobs, you're not going to have a growing population. So you got to look at some of those things. You got to look at absorption, construction, things like that. The next step is, identifying the assets. And I think the assets really, the way that, for the most part, we like the idea of creating equity as much as possible. And that's where the whole buy and hope thing is not necessarily a good idea. Obviously, you got to hope a little bit anyway, because it'll make a difference, if you have tailwinds behind you or against you. But, looking at what given properties comparable, what kind of rents are they getting? What are the comps? When was the last time this thing was updated? Those kinds of things. You want to make sure that you have an ability to force equity, right? Equity happens not only by changes in the macroeconomic landscape, but it also happens on the level of the property itself. And like in any business, it ends up being a simple matter of, can you increase income and decrease expenses, or at least create more delta? And if there's not an opportunity to do that, that's generally not in our buy box, right? There's nothing wrong with buying an asset that, of course, is, already in a good shape, and you're just going to plan to hold it for a long time and get cash flow. There's nothing wrong with that, but that's just not kind of what we do. We look for opportunities, and we look for opportunities to increase rent that's realistic, and ultimately be opportunistic about when we sell.
I'm going to dig into the weeds here for just a second. This conversation popped in my head, which is that I've heard you talk an awful lot about the tax stack, and I want you to sort of pressure test, when do you prefer bonus depreciation plus a cost seg over like a 1031 exchange?
Or combination of all three.
Yeah. And what common mistakes do you see passive investors make around recapture, that burn passive investors when they're trying to do that trade up?
Yeah. So the good thing is, with the new Trump getting back to 100% bonus depreciation, right? You almost don't need a 1031 exchange, right? Most of the time you don't. I mean, if you have leverage on something, you think about it, right? Like, so if you came out of something, you came out with it with, say, $200,000 of profit, and, you had $300,000 as your basis, and now you have $500,000 there. Your taxes on, your capital gains taxes on that $200,000, right? Now, what if you take the whole $500,000 and you invest it in something that's using, I don't know, let's just for round numbers, 70% loan to value, right? So you bought something for, I don't know, $1.5 million from that $500,000. Now, if you do a cost segregation analysis on that, at least in multifamily, almost always it's going to be about 70% of that property is going to be real property, and 30% of it is going to be personal property. Well, guess what? Your $500,000 basically is 30% of that new property value. So the bottom line is you've essentially erased all your tax liability. So right now with 1031 exchanges, they're not, for the most part, they're not necessary. They're really not. And sometimes they're just kind of a pain because it puts you in a box. You have to sit around and you have to find something quickly. You might end up having to buy something you wouldn't otherwise want to buy. So that's a big advantage for limited partners, because most of the time you can't 1031 exchange into one syndication into another, right? Sometimes you can. Sometimes we have some ways that you can do that. However, most of the time with syndications, you can't do that. But as long as you're kind of rolling it forward, it's sort of like a hamster wheel, right? It's a golden hamster wheel, right? One that's going to save you money and let you grow your wealth. So yeah, right now, I don't really see a big value in 1031 exchanges, even for people who just got their own properties.
And how do you typically, one of the challenges that we try to focus on with LPs is, if you got an exit towards the end of the year, that's, that can be a challenge. Now you're suddenly kind of scrambling for, all right, now we got to find somewhere to put it. And are we going to take that bonus depreciation in that year, or is it going to be in the next year? How do you typically deal with that?
Well, if it's toward the end of the year, first of all, we try not to have exits or the end of the year, right? It just puts everybody in a bad position there. So that's probably the biggest thing. But that probably is one of the indications for a 1031, right? If you just don't have the time and, you don't want to pay the tax, then do a 1031. You give you a few months to figure things out. So,
I'm going to ask a selfish question here, as most of them are for me, because it's rare for me to get the opportunity to pin you down on things like this. So I utilize the infinite banking. I have overfunded cash value life insurance policies that I am able to. So I get the death benefit. The death benefit is almost an ancillary benefit. There's some tax benefits from that, but also I can borrow against that and then turn around and put that to work. And if I'm paying like 4% on a loan to get that money back, if I can turn around and put it into something else, it starts to get to the point of compounding, and the break-even point of paying into that is usually like 2.7, 2.9 years, something like that, and then it starts to ramp up. That's a little oversimplification for those listening. I know that you're a proponent of overfunding whole value life insurance policies. What's your strategy on this? How do you educate? Give me the high level view of what you say to your people that are listening to you.
Well, yeah. So I started doing this stuff myself, and as is often the case, is sort of ended up building a business around it. So, we have our Wealth Formula Banking, wealthformulabanking.com is, where we do, where we provide some of this stuff. But the idea is, for the most part, as you said, to me, the value, the big thing that from the infinite banking or what we call wealth formula banking is effectively because you have money growing at a fixed rate, right? The dividend plus the dividend, which is for most insurance companies, it's not something they're not going to do. That, Penn Mutual, Mass Mutual, these companies have had dividends nonstop for over 100 years, right? And then there's a guaranteed rate. So you have say maybe you're rolling around at, 5%, which is not great, but it's better than sitting in, a checking account or savings account getting less than 1. And you get what you're doing there essentially is you're getting the opportunity to borrow that money to deploy into something else. Now, here's the catcher. When you borrow, you're borrowing at a simple interest rate off of the insurance company's ledger. Okay. Meanwhile, your money that was growing at 5, maybe 5.5%, whatever, continues to stay there and grows at a compounding interest rate. So essentially what that allows you to do is take the same money and grow it in 2 different places at the same time. And that, to me, when I figured that out, I was like, oh, that's what they mean about. And I kept hearing people talk about be your own bank. And for the longest time, I was like, what the hell does that mean? I don't even know what that means. But then it clicked and it made a lot of sense. And then when I kind of went down that pathway with life insurance stuff in general, I mean, there's just so much you can do there. It's insane. Just anecdotally, I mean, we ended up getting into what are called leveraged IULs, which basically, and this type of product, that cash value grows with a cap and a floor. You can say 10%, you take the top and nothing more than that. And then if it hits 0, you don't take, you don't participate in the S&P 500 losses, right? But if you leverage that up, guess what happens? That if you get a 10% gain and you're levered up, you end up with a, 20% gain or more. And again, you don't take losses. So that was pretty cool. And that's something we've been doing for retirement income stuff as well. I'm not a big stock market guy, but if you put guardrails around on it and put leverage on there, it sounds pretty good. But the other thing that's interesting about that is you can get with these life insurance products like that, you can get some really interesting tax plays as well. Like you can, essentially pledge your death benefit to charity and not pay ultimately on those charitable dollars until you die, because you can have a third party lender front you that money. We have all sorts of stuff generally for people who are, probably making at least 700-800 grand. It's going to work if you do, if you've got an AGI of 700-800 grand. But anyway, I digress. My point is that's an area that I really like. I just think there's just so much you can do there that you don't learn if you're getting the lessons of the middle class and the poor. I mean, these are all stuff that we're kind of yanking out from the ultra high net worth world, right? So
That's exactly what's happening is you're taking all these quote unquote secret formulas that are now becoming exposed to the masses. And we have a way to communicate now that the world never had before. So there's more noise and distraction, but there's also more opportunity than ever before. And if you connect with people that are trying to educate you versus people trying to sell you something, I think that's the best way to move forward and find that. And that's the key for me is like, that's the concept of infinite banking is that in its simplest form is you're taking money and you're able to use the same dollars and invest it twice. And that's really the key benefit there. So you rinse and repeat. And I love that. And my fear with this interview is that there's so many different directions I would like to go. I use the analogy of like sometimes I feel like I'm on an island and I can see the mainland and I have enough lumber to build the bridge to shore and I build it 10 feet in 15 different directions. The next thing you know, I haven't gone anywhere and I'm out of wood. Right. So I don't want that to happen with this interview, but there's so many things with you I want to ask. I want to take a little bit of a foray into fitness, sleep, hormones, nutrition, because we're talking about there's a distinction between being rich and having wealth. And what we're talking about is creating wealth for your family in a way that can change what your family looks like in terms of financial velocity for generations. And what's the point of all of this if we're not taking care of ourselves and our relationships? I was a medical rep at the hospital for 16 years. I hung that up in 2022. And since then, I've lost 50 pounds and I've changed the way I eat. I've changed the way I exercise, and I'm still constantly learning. And the biggest thing that I have learned is how far I have to go and how much I have to learn. And it's daunting. I love Dr. Peter Attia. I love a lot of the things that the access that we have to health in terms of self-education. But from your perspective as a physician and with this wealth perspective, where do you stand on like things like fitness, on sleep, on taking care of ourselves, the priorities? Like, what's your standpoint on that, the way that you educate?
Well, it's funny you say that because most people don't know, but I have another podcast called Longevity Roadmap.
Here we go. I knew it. I knew it was in there.
And again, this started essentially because it's, in the same way with the wealth stuff, I got really interested in, longevity science, got really interested in what was coming down the pike. I think there's just an enormous amount of stuff there. My podcast tends to be a little bit wonky. It's I talk to guys who are doing basic science research at the Buck Institute and stuff like that. Going back to my own background as a biochemistry guy. And so just trying to keep myself busy. But listen, bottom line is, I think that's a very good point. I think we have to take care of ourselves, and we have a lot of tools to do that these days that we didn't have years ago to monitor our own health and to get educated on things ourselves as well. You mentioned Peter Attia. Peter's a great example of that. Just being able to provide that information. There's ways to monitor yourself now. You can get your own lab tests. You can get an Oura ring, for example, to monitor your sleep and get a lot of information online on what that is all about. Diet's nebulous, but at the end of the day, I think there's some things that people agree on. But yeah, I think it's all part of the wealth, playbook. So,
well, we're running out of time, but I don't want to let you get away before we ask you about the economy. You're a macro guy. You look at the macro economy. We all do. Anybody who's involved in this industry, you have to keep an eye on it. So we're now sitting here September 18th.
Day after a rate cut.
Yeah, day after a rate cut. What do you, give us not your crystal ball, but what's your feeling about what's going on in the economy right now?
Yeah, I think sometimes you just got to kind of look at what's happening in the big picture, right? And I think the biggest thing is that if you look at what the Trump administration's doing, they're going to take over the Fed, right? There's Stephen Moran, I think, just got appointed one of the governors. They tried to fire another governor. I don't know how that's going to work out in the end, but Powell's going to get replaced. At some point, they're going to get control of this. And what the Trump administration wants to do, if you read Stephen Moran's work, it's very clear. The guy he just appointed to the Fed. The idea here is essentially tariffs was the first thing they wanted to do. The next thing they want to do is they want to get rates down, right? The Fed rates will come down. They've already coming down 25 basis points. They're going to come down more. They're going to come down another 100 basis points in the next year, in my view. And I think there's always this concern, well, the Fed rate goes down, but what about the bond market? Well, they're also in control of quantitative easing, right? So you always just have to look at what the president is saying at this point and what they're doing. If they get control of the Fed, which they will, interest rates are going to come down. They are going to come down precipitously. And that is going to create a tremendous amount of liquidity in the economy. And that is good for assets. Okay. It's good for real estate. It's good for stocks. It's good for gold and Bitcoin. It's good for everything. What it's not good for is the dollar. The dollar is going to, have a real valuation issue, right? It's going to continue to depreciate. So from my perspective right now, the reality is that we are in a imminently descending interest rate environment. And if you look at, we were talking about the financial crisis before, right? In 2008, what was the big thing that really ended up giving us a bull market for 15 years? It was massive rate cuts, really low rates. And it drove this market. To me, we have a lot of information right now. I would bet on this, that we are at the beginning of that next bull market, because rates we're going to be in a descending rate market again. What happens in a descending rate market? Well, beyond the fact that I just mentioned the additional liquidity, when interest rates go down, cap rates compress. So if you're buying real estate right now, you're gonna benefit from that. You're going to benefit from cap rate compression because interest rates come down, values go up. So if you're finding deals that work at the prices of interest rates today, they're going to work really well when these rates come down, and we're looking in 2 years with a ton of liquidity. So my own feeling is it's a great time to buy. It's a tricky thing because a lot of people are scared. I get it. I totally get it. I mean, I've taken some beatings myself from 400 basis point increases in interest rates over the course of a very short period of time. Everybody did. But if you look at what's happening, it's pretty clear to me that we are heading in this, the beginning of potentially a really, really big bull market, not just for real estate, but for stocks and everything else. So I just think people need to get off the sidelines and start buying stuff. I don't care what it is. Buy stocks, buy real estate, buy things that are not going to lose value while this happens.
Yep. Turn those dollars into dirt, because those dollars are going to lose value and the dirt's not. It's going to go the other direction. Go ahead. You got a follow-up question?
Yeah. One last follow-up question. Do you have any concern with, if the president sort of takes away the independence of the Fed, that will spook the bond market? And then, like we talked about, the 10-year treasury, all of a sudden the bond traders are like, well, this looks like, I don't like the way this looks. I'm going to, we're not going to buy bond them, and we're going to start jacking up the prices on the bonds.
That is a concern if the administration is not in control of the Fed. However, if they're in control of the Fed, it's called quantitative easing, right? The next thing you know, you've got monetary policy. You're just the basically buying a huge amount of bonds from the open market, and that brings yields down. They have complete control of that.
Yeah.
Gotcha.
Well, I'm going to let Neil ask the last question. Before he does, I'm going to ask my last follow-up question. And this is, you got two podcasts. I don't know how you find the time for all of this, but you got two different podcasts out here. You're also the author of, I said this in the intro, we want to make sure that the listeners know that they need to go read The 7 Secrets of Eternal Wealth. That's a book that you have as well. Besides those two podcasts, in terms of the way that you're educating and you're sharing your knowledge and everything that you're picking up from these different sources, do you have a mastermind or anything like that? Or let me ask the question a different way. What is the best way for people like me to stay engaged with you and hear what you're coming up with based upon what you're learning in the market?
I mean, pretty much, that's what my podcast is about, right? Generally speaking, we don't talk, we certainly talk about personal finance strategies. But when it comes to macro, when it comes to what I'm thinking right now, and again, just with my podcast, again, it's definitely not just a real estate podcast, right? Definitely not. I mean, I think I've been talking more about Bitcoin lately than I've been talking about real estate. But I think if you like the idea of at least having opinions that I'm generating from the people I'm talking to, the podcast is by far and away the biggest way to do that.
So this is a question we ask all of our guests. What is a book that you find yourself recommending again and again to friends and colleagues?
I think we'd probably go back to the cash flow quadrant. I mean, I think for, especially if you are, you're a physician who was like me, who had your face down in books and, academia and stuff like that, and really never considered all of these other things out there like tax, beneficial investing, business ownership, things like that. It's a real eye opener. And, I think, again, it's you read it. If you read it, it just seems so it's written at such a basic level. But, in talking to Robert Kiyosaki, though, that book he wrote for high paid professionals, because when I told him that was the book that got me into his stuff, he said, well, that makes sense because I wrote it for you.
Yeah, his style is such an easy read. Like that's why it resonates with fifth graders or people that are, 95 years old. It just carries weight. So I love that. We've probably had 40 or 50 people, if not more, recommend Robert Kiyosaki, but it's always Rich Dad, Poor Dad. And for me, I've always got more value from Cash Flow Quadrant. So that resonates with me. Listen, for the sake of time, we're going to wrap it up here. But I've loved this. This has been a great interview. Dr. Buck Joffrey, I really appreciate your time and your willingness to come on and share and educate. So thank you so much for that. If any of our listeners want to connect with you, hear more about what you're up to, I think I know what the answer is going to be. But would you please tell us the best way that they can do that?
Well, there's a website called wealthformula.com, and there's some resources there. There's some things you can sign up for. Otherwise, it's the podcast, Wealth Formula Podcast. Been around for a long time, probably continue to be around for a long time. So that's probably the best way.
Awesome. Well, thank you, Buck. We really appreciate your time. Thanks so much.
Yeah, I've enjoyed it a lot.
You bet. Take care.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.